Welcome back to Part B of Topic 2 lecture. We will discuss Learning Objectives 7, 8, 9, and 10. In Learning Objective 7, our aim is to understand the importance of identifying an organization's cost driver. The phrase different cost for different purposes is often used to convey the notion that different characteristics of costs can be important in order for us to understand a variety of managerial situations. One of the most important cost classifications involves the way a cost changes in relation to changes in the activity of the organization. So an activity refers to a measure of the organization's output of products or services. And the activities that cause costs to be incurred are called cost drivers. So what are cost drivers again? These are activities that cause costs to be incurred. Here are some examples of cost drivers. So, an activity could be the machining operations. What drives the costs incurred in machining operations? Well, the number of machine hours. The more you use the machines, the more your cost in operating the machines would be. Therefore, machine hours would be the cost driver. Another example, in setting up of the equipment and the like. The cost driver could be the number of hours it takes to set up the equipment, or it could be the number of setups that are being done. So if you are producing a batch of product X, for example, you'll need to change the setup of the machine. When you are producing a batch of product Y, you'll need to change the setup of the machine. So the setup hours or the number of setups could be the cost driver. What about in production scheduling activity? Well, the manufacturing orders could be the cost driver. As there are more manufacturing orders, there will be higher production scheduling costs. How about inspection? Well, the number of units that are being inspected could be the driver for the inspection cost. Purchasing would be driven by the number of purchase orders made. Shop order handling activity would be driven by the number of shop orders. Valve assembly support, for example, could be driven by the number of customer requisitions. The higher the customer requisitions, the higher the valve assembly support would be. So it is important to understand the drivers of these costs so that if we would like to manage the activity cost more effectively, we would look at ways and means to manage the drivers of those costs. Do we really need to inspect each and every unit, or can we do random inspections instead in order for us to reduce the costs incurred for inspection, just as an example? The importance of cost drivers will again be revealed as we go through future topics in cost accounting, but it is important at this stage to have an overall understanding of the importance of cost drivers. Let's move on to Learning Objective 8. Here, we will describe the behavior of variable and fixed costs in total and also on a per unit basis. After identifying cost and cost drivers, management would normally examine the relationship between various costs and the activities performed. So such relationship is referred to as cost behavior. Some costs are variable and some costs are fixed. So let's look at variable costs first. Variable costs are those costs that change in total proportionate to the changes in the related level of activity or volume. So If, for example, it costs us $10 of direct materials per unit, if we produce 1 unit of this product, we will spend $10 of direct material cost. But if we produce 100 units, then that means we will be spending $1,000 worth of direct materials. $10 times 100 is 1,000. So this is an example of variable cost because it changes in total in proportion to the change in the volume of production. Now, notice, however, that variable costs are constant on a per unit basis. So if I produce 1 unit of product, the cost per unit of direct materials is $10. But when I produce 100 units of the same product, the cost per unit of direct materials is still $10. The total cost will be $1,000. It increases proportionate in total according to the volume of production, but on a per unit basis, variable cost will remain constant, will remain the same. So whether I produce 1 or 10 units or 100 units, the variable cost per unit is $10. All right. What about fixed cost? Fixed costs by nature remain unchanged in total regardless of the change in the related level of activity or volume. So an example of a fixed cost would be the factory rental. All right. If we are renting the factory for, let's say, $5,000 per month, all right, and we produce 5,000 units per month, then that means the cost of rental per unit will work out to be just $1 per unit. So $5,000 in rental divided by 5,000 units produced in the whole month, that means $1 in rental cost would be incurred per unit, right? But if we produce only, let's say, 1,000 units in 1 month, do we pay less in rental? No, we will still pay $5,000 in rental cost, right? So that means per unit, our rental cost would no longer be $1 per unit. It will be $5,000 divided by 1,000 units. We only produce 1,000 units in this month, for example. So that would mean that our rental cost per unit is $5 per unit. All right. When the volume of production is higher at 5,000 units, our fixed cost per unit was just $1. But when we produce less, 1,000 units for the whole month, our fixed cost in total is still 5,000. So our fixed cost per unit has increased to $5 per unit. So what can you see here? Fixed costs remain unchanged in total, regardless of the volume of production, whether we produce 5,000, 1,000, or whether we produce 1 unit, our fixed cost in total will still be 5,000. But the fixed cost per unit will be inversely proportionate with the level of production. So at 5,000 units produced, our fixed cost per unit was $1. At 1,000 units produced, our fixed cost per unit would be $5. If we produce just 1 unit in 1 month, that means our fixed cost per unit would be $5,000. All right. We can actually say that there is kind of a third classification of cost according to behavior, because there is this what we call the mixed cost. They are semi-variable, semi-fixed costs. They contain a proportion of both variable and fixed costs. And an example of this would be motor vehicle expenses. All right. There is, for example, a lease cost, which is fixed. If we are leasing the motor vehicle, we will be paying that maybe on a monthly basis, and that lease cost is fixed. The fuel cost will, however, be variable, and it will depend on the kilometers that we travel. The more we travel, the more gasoline cost there would be. The less we travel, the less gasoline cost. If we put these costs in a graph, the variable cost will be as shown here in the first graph. If we are producing more units, the total variable cost will be increasing. All right. So in here, if our variable cost per unit is $60, as shown here, at 1,000 units, we would have spent $60,000 in total variable cost. If we produce 2,000 units, our total variable cost will be $120,000, and it will increase proportionate with the volume of production. What about the fixed cost? Well, fixed cost will remain the same regardless of the volume of production. So here we've got the volume at 20,000, at 40,000, at 60,000 units, and the fixed cost, which in this example is the supervision cost, is remaining at $2 million, all right, regardless of the volume of production. Okay, so let's just summarize the cost classification in terms of variable and fixed cost. Remember that variable cost in total will change according to the activity level, according to the volume produced, for example. But on a per unit basis, variable cost will remain the same over wide ranges of activity. So variable cost per unit will remain constant. Fixed cost, on the other hand, is kind of the opposite. So fixed cost in total will remain the same even when the activity level changes. But on a per unit basis, fixed cost goes down as the activity level goes up. It's important to know this cost behavior and these cost drivers that we have learned in Learning Objectives 7 and 8 because it is useful for cost management systems. The objectives of cost management systems are fourfold. First, it aims to measure the cost of resources consumed. Second, it identifies and eliminates non-value added costs. Why do management need to identify and eliminate non-value added costs? Because incurring non-value added costs will increase the cost of the production while it's not adding value. That's why it's called non-value adding. It's not adding value to the product. So if we can eliminate those non-value added costs, then we can be more efficient in our production and we can offer a product that is of value to the customers at a lower cost, making us more competitive. Third objective of CMS, or cost management system, is to determine efficiency and effectiveness of major activities. Again, so that we can be more efficient in our cost management. And finally, it aims to identify and evaluate new activities that can improve performance. This will help the company to be at the forefront of innovations in terms of their processes, in terms of production, and also remain competitive in the market. Right. Let's move on to Learning Objective 9. Here, we will distinguish among direct, indirect, controllable, and uncontrollable costs. We have already been introduced to direct costs, direct materials, direct labor. So those two costs are direct costs. Direct cost to what? Perhaps that's a question that we should ask. All right, so let's look at direct costs first. Direct costs are costs that can be easily and conveniently traced to a product or department. So this product or department are what we refer to as cost objects. Why do we want to know the cost of a product? Because if we know the product cost, we can add the desired markup and then we can determine the price that we would be selling our product and achieve the profit that we wanted. So a product is one cost object. A department could be a cost object. If we want to know how efficient the department is and if there are any way by which we can reduce the cost of that department, then we want to look and analyze the cost structure for that department. A department could be the accounting department. So each of these could be cost objects. So a cost object is simply anything for which we want to know the cost of. All right. So when we're talking about direct cost, we need to know what the cost objects are so that we are able to determine whether we can easily and conveniently trace the cost of that cost object. So examples of direct cost, an automobile manufacturing environment, the cost of the paint in the paint department of that assembly plant would be a direct cost to the department. So what's our cost object here? The department. All right. What about indirect costs? Well, indirect costs are those costs that must be allocated in order to be assigned to a cost object, whether it's product or a department. So an example of an indirect cost could be the cost of national advertising for an airline. If our cost object is each particular flight, all right, then the advertising cost is not directly traceable to any particular flight, and therefore it is an indirect cost. So because indirect cost cannot be traced easily to any cost object, what we need to do is to allocate these indirect costs. So let's go back to the manufacturing costs that we've looked at. The three manufacturing costs that we've looked at are direct materials, direct labor, and manufacturing overhead. So direct materials and direct labor are direct costs because these costs can be traced conveniently to the cost object, and our cost object would be the product. What about the manufacturing overhead? Now recall that manufacturing overhead is really a big cost pool of different costs. It includes indirect materials, it includes indirect labor, it includes all the other costs incurred in the factory, such as what? Depreciation of machinery, the supervisors' salaries, cleaning costs of the factory, the utilities, electricity, and all that. So when we pool all these costs together, we put it in a manufacturing overhead account. All right. And so this manufacturing overhead cost cannot be easily and conveniently traced to any particular product that is produced in the factory. And so these manufacturing overhead costs are a good example of indirect cost. So what do we do with the manufacturing overhead cost? Since it cannot be traced to the cost object, it needs to be allocated. And we'll learn more about allocating costs in the next few topics to come. But for now, what we're going to do is to have an exercise on cost classification. In this exercise, we are going to classify the costs for a company that is involved in the service sector. So far in this lecture, I have introduced you to two types of companies, merchandising and manufacturing. There is a third type, and that is the service company. Market Focus is a marketing research firm that organizes focus groups for consumer product companies. Each focus group has 8 individuals who are paid $60 per session to provide comments on new products. These focus groups meet in hotels and are led by a trained independent marketing specialist hired by Market Focus. Each specialist is paid a fixed retainer to conduct a minimum number of sessions and a per session fee of $2,200. A Market Focus staff member attends each session to ensure that all logistical aspects run smoothly. We are required to classify each of the cost item A to H, all right, either as direct or indirect. And it says here that our cost object would be the focus group, all right. When we are classifying the cost either as direct or indirect, we need to look at the cost object being the focus group. All right. And we are also asked to classify whether these costs are variable or fixed. So for each item, we'll need to determine whether it's a D or I, direct or indirect, variable or fixed. Let's now get started with the classification of costs. Let's start with A, payment to individuals in each focus group to provide comments on new products. So that is this $60 payment per individual. Would that be direct or indirect? We can actually trace it directly to each focus group. That's the cost object, isn't it? All right, so that would be a direct. And would it be variable or fixed? So remember here, it says that variable or fixed cost of how the total cost of market focus change as the number of focus groups conducted changes. So the volume here is the number of focus groups conducted. In this case, this payment to individuals will what? Will vary depending on the number of focus groups conducted, right? And so this will be a variable cost. So it will be a direct and variable, DV. Let's go to letter B. Annual subscription of Market Focus to Consumer Reports magazine. All right, so when you have a subscription to a magazine, would that be variable or fixed? It's actually fixed for the entire period, isn't it? So that is definitely a fixed cost. But is it direct or indirect? Can we directly trace this subscription to magazine to each focus group? No, we can't, isn't it? So therefore, it is an indirect. So it's indirect and fixed. Let's go to C. Phone calls made by market focus staff member to confirm individuals will attend a focus group session. And then in parentheses, it says the records of individual calls are not kept. If the records of individual calls are not kept, can we trace these calls to each focus group? Well, the answer is no, we can't trace it. All right? And that makes it indirect. Now, the phone charges, would that be variable or would that be fixed? Well, if you are paying according to the number of minutes or according to the number of calls, then it will vary, isn't it? So therefore, it will be an indirect cost and a variable cost. However, if your phone bill is paid on a monthly basis and it doesn't vary according to the number of minutes or according to the number of calls, then it could be a fixed cost. So it depends on the company's phone plan. So we are assuming here that the company is paying the phone bill according to the number of calls or number of minutes per call. Let's go to letter D. Retainer paid to focus group leader to conduct 18 focus groups per year on new medical products. So this retainer that we mentioned earlier is stated here. Each specialist is paid a fixed retainer to conduct a minimum number of sessions. So that retainer payment is a fixed component. And is that direct or indirect? Well, can we trace this retainer fee to a particular focus group? The answer is no, we can't. So therefore, it's indirect and it is fixed. All right. Letter E, recruiting cost to hire marketing specialists, direct or indirect? Well, this would be an indirect cost because we can trace it to a particular cost object, in this case, the focus group. Will this be fixed or variable? This would be a variable cost. Let's go to letter F, lease payment by market focus for corporate office. So lease payment is what? Normally fixed cost. And would this be direct or indirect? Again, corporate office cost will not be directly traceable to any focus group. So that would be indirect and fixed, IF. What about G? Cost of tapes used to record comments made by individuals in a focus group session. And in parentheses, it says these tapes are sent to the company whose products are being tested. Can we trace this cost of tapes to the cost objects? Well, we can, and so that would make it direct cost. Is this variable or fixed? Well, the more focus groups, the more cost of tapes will incur. The less focus groups, the less we would incur. And therefore, this is variable. So direct and variable. What about H? Gasoline costs of market-focused staff for company-owned vehicles. And they say staff members submit monthly bills with no mileage breakdowns. So if there are no mileage breakdowns, then that means we can't trace what those mileage pertain to, and therefore it can't be directly traceable. So it is indirect. But gasoline costs, are they fixed or variable? Well, we can say that this is variable because the more you travel, the more gasoline cost you will incur. And so it will be indirect and variable. And finally, letter I pertains to costs incurred to improve the design of focus groups to make them more effective. Well, we can't really trace this to the focus groups, so this would be indirect. And if we are paying this cost on a fixed basis, so it will be fixed, and so it would be indirect and fixed. Okay, let us now move on to the second part of learning objective 9, and that is looking at controllable versus uncontrollable costs. Another cost classification that can be helpful in cost control indicates that controllability of a cost item by a particular manager is important. So what are controllable costs? A cost that can be significantly influenced or controlled by a manager is a controllable cost. Here are examples of cost items, and we will discuss whether this cost is a controllable or an uncontrollable cost. So let's look at the first one, the cost of raw material used to produce computer chips in an Intel factory. The manager that is responsible would be the supervisor of the production department for computer chips. The question is this: can the supervisor significantly influence the cost incurred for the raw materials? The likely answer is yes. If the manager would like to produce more, then they will have to incur more of these computer chips cost. If they produce less, then they will not need to buy more and therefore not incur higher costs. Also, if the production supervisor can exercise some degree of control over the spoilage or wastage, then there will be less defective units and therefore the cost of computer chips will be minimized. So that is an example of a controllable cost. Let's look at this next item. What about the cost of food used in a Subway restaurant? Who is the responsible manager? The restaurant manager. Can the manager control the cost of food? Again, yes, they can. The restaurant manager can exercise some degree of control over the quantity of food used by scheduling production to ensure that excess food is not produced and therefore wastage again would be reduced. Let's look at the third example. What about the cost of national advertising for the enterprise car rental company? Who is the responsible manager? The manager of the rental agency, for example, in one location, say at the Orlando airport. Can the manager control the national cost of advertising? Well, the reality is he can't, because the national advertising is decided by the head office, and therefore the manager is not able to influence significantly the advertising cost. So that is an example of uncontrollable cost to the manager of a branch. What about the fourth item? Cost of national accounting and data processing operations for Target. So who's the manager responsible, the manager of a particular store, for example, the store in Austin, Texas. Can the manager in Austin, Texas control this data processing operation cost? He or she can't. Why? Because this is again decided by the head office and therefore beyond the control of the manager of the branch. All right, let's move on to the last learning objective. In learning objective 10, we will define and give examples of number 1, opportunity cost, number 2, out-of-pocket cost, number 3, sunk cost, 4, differential cost, 5th, marginal cost, and 6th, average cost. Let's start with opportunity cost. What do we mean by opportunity cost? This is the benefit that is foregone or sacrificed when the choice of one action precludes taking an alternative course of action. So an opportunity cost arises in many business decisions, but a lot of times this opportunity cost is ignored simply because an opportunity cost is not a cost that is shown in the accounting transactions. All right, so what's an example of an opportunity cost? If you were not attending AIU now, could you be working? Yes, most likely. If you could be earning, let's say 30,000 per year, your opportunity cost of attending the university for 1 year would be 30,000. So as you can see, you will not be recording this 30,000 because this is really not a cost that you are going to incur. It's not your out-of-pocket cost, isn't it? All right. So in a business situation, if, for example, you decided to invest your money, your excess cash, to marketable securities that could earn you, let's just say, only 2% per annum. But then you have another opportunity to earn 10% per annum. All right. So you are sacrificing the 10% because you chose to invest your excess cash in marketable securities that will only give you 2%. So in this case, the opportunity cost really is that benefit that you have forgone or sacrificed. Contrast opportunity cost with out-of-pocket cost, where out-of-pocket costs are those costs that require the payment of either cash or other assets as a result of its incurrence. So going back to the example of your studies at AIU, your out-of-pocket costs would include your tuition fees, your board and accommodation expenses, and the like. Now, it's important that from an economic perspective, the dollar of opportunity costs associated with an action be treated as equivalent to $1 of out-of-pocket costs. A lot of times, businesses will only base their decision on out-of-pocket costs because that will be shown in accounting transactions and they have to account for it. But opportunity costs a lot of times are ignored. When we go to relevant costing later on, we will be talking more about this opportunity cost and its importance in decision making. Let's move on to sunk costs. What are sunk costs? Well, these are all costs incurred in the past that cannot be changed by any decision made now or in the future. So sunk costs are historical costs, and sunk costs should not be considered when making a decision. So an example of a sunk cost is this. You bought an automobile that cost $22,000 2 years ago. So the $22,000 cost is a sunk cost because whether you drive your car, park it, trade it, or sell it, you can no longer change that cost. So in your decision to whether sell or not sell the car, the $22,000 original cost is irrelevant. Let's move on to differential costs. These are costs that differ between alternatives. That's why it's called differential costs. An example is, say, you can earn $1,500 per month in your hometown or $2,000 per month in a nearby city. let's say that your commuting costs are $50 per month in your hometown and $300 per month if you work in the nearby city. So what is your differential cost? The differential cost would be 300 minus 50, that is $250. But what is your differential earnings? It's 2,000 minus 1,500, so that means $500. So your differential net earnings would be 500 minus the differential cost of 250 equals $250. So you are still better off to work in the nearby city because your differential earnings is 500 and your differential cost is 250, thereby giving you a positive balance of $250. Let's move on to marginal cost and average cost. A special case of the differential cost concept is marginal cost, which is the extra cost incurred to produce one additional unit. An average cost, on the other hand, is the total cost to produce a quantity divided by the quantity produced. It's important to note that the marginal and average costs are largely a function of cost behavior, the variable and fixed costs, because the marginal cost would most of the time be your variable costs. But your average cost will include both the variable and the fixed costs. Now, we will be talking more about this concept of marginal cost and average cost, sunk cost versus differential cost, as well as the application of opportunity cost as we move on to future topics. Well, as you can see, we have covered quite a lot of different cost concepts in this topic. We have explored the definition, the different cost classifications, and pretty much the phrase different costs for different purposes was coined. An important task for managers is to really weigh the benefits of providing information against the costs of generating, communicating, and using that information. When managers receive more data than they can utilize effectively, there is what we call information overload. So in deciding how much and what type of information to provide, managerial accountants should consider these human limitations. So I hope you are not too overwhelmed with all these cost classifications that we have introduced in this topic. Now, to end, I just would like to share with you another Bible text because I've been showing you this way of wisdom, right? And we've been talking about costs. It says actually in the book of Proverbs, the beginning of wisdom is this: get wisdom, though it cost all you have, get understanding. So that is found in Proverbs chapter 4, verse 7. And in a sense, I'm sure you already know this because otherwise you will not be spending a lot of time, money, and effort in getting the education that you are doing right now. So this may cost you a bit, but in the long run, getting understanding and obtaining wisdom is very important. Shall we close with a word of prayer? Most gracious Heavenly Father, thank you so much for this opportunity to learn more about cost and cost management systems, as well as the concepts that comes with it. Father, we pray that as we delve deeper into these topics, that our understanding will grow, but not just academically. We pray that each one of us too will learn the importance of spiritual health as well. We ask this in Jesus' name. Amen. All right, so I will be seeing you in class shortly. I look forward to it. Bye-bye for now.